Kim, good to see you. We are talking about a tax smart alternative to cash. As we've discussed before, following several rate hikes from the Fed, investors can once again earn attractive rates on cash. But after accounting for taxes, your investment may not even be keeping pace with inflation. So, what are some of the questions a risk averse investor should ask when considering CDs, treasuries, or other cash savings?
Yeah, with the interest rate environment going up, those rates are very, very attractive. You can get a money market fund right now paying, 5.25%
Right.
almost. So one of the first things that should be looked at is what is your time horizon for these funds? If it's a longer time horizon, then there may be other better investment options that should be pursued. But to your point, taxes should also be considered. And this is something that is far too often overlooked with this topic, especially because if you have a nice money market fund and you're getting those interest payments, this isn't necessarily triggering your mind when you're seeing those interest payments hit because you owe the taxes later. So,
Right.
for example, these are the 2024 tax rates. If you're in that 24% bracket and you're earning that, almost 5.25 on that money market account, your actual return is less than 4% due to the taxes you owe on that money because that interest is taxed at whatever rate you're in. So that's one of the things that you really have to consider when you're discussing how much money should be in a money market account or savings or those other cash equivalents.
And just to remind everybody right now, inflation's still standing at about 3%. So I want to talk through some tax smart cash alternatives, specifically buffered ETFs, because some of them have full principal protection as well.
Yes. So these can be a good strategy, like I said, for those that might have a little bit longer of a time horizon. So they're wanting a little bit more potential return, but also wanting that safety element of those cash equivalents. This could be something to pursue. So in a buffered ETF, there's all different types, but to your point, there are some types out there that have a floor as far as you can't lose, but you can go up some if the market index is positive. So for example, you might have a buffered ETF that has a cap of, 8, 9, 10%, meaning that if the market goes up during that time period ahead, you can get up to that growth. But if the market goes negative, you're not going to lose. So again, for people that might have a little bit more appetite for risk, that might be a good option to pursue.
hmm So let's talk through those taxes again, because as you mentioned, very important and often overlooked, cash alternatives, and bonds are all subject to income taxes, whereas buffered ETFs don't generate that taxable interest.
Correct. So one other thing that's very attractive about them is they're going to have that traditional capital gains tax element to them, meaning that you're going to get the price valuation increase. So you're going to be in the driver's seat as far as when you're going to create that taxable event for yourself. So if you're just going to hold that position and then down the road sell it, that's when the taxable event will occur to you at whatever at whatever likely long-term capital gains rate bracket you're in at that time, which for some people is 0%, some people is 15%. And then for the, ultra higher net worth people or income people, it's going to be that 20%. So those rates are generally more favorable than how your money market and CD and savings interest is going to be taxed to you.
Kim, we talk all the time, but today you are actually blowing my mind. It's really interesting to learn this. I think a lot of people don't recognize this. I didn't realize it. So this is very helpful. If somebody has questions about safe, tax smart cash alternatives, what's the best way to reach you?
Yes, lots of options that we can talk through. The best way to reach us is to go to our website, www.young-wm.com, and it'll be different ways for you to interact with us, and we'd love to have a conversation.
Great. Kim, thank you.
Thanks.